Hello, everyone. Welcome back. So this session is the continuation of our earlier audit and assurance areas. Okay. So today we are going to be doing ISA 210, which is agreeing the terms of the audit engagements. Now, see, like any other job or any other task that you undertake, okay, it is very important that you set the expectations clear. Now, what do I mean by setting the expectations clear? Let me just quickly. Yeah. So as the term suggests, it means agreeing. Agreeing means, sorry about the delay. Agreeing means that I will agree with the management of the organization what I will do in an audit of the financials. Okay, this is very important. Agreeing the terms of audit, extremely important. So the international standard of auditing honor defines the auditor's responsibilities. Okay, so this is the auditor's job. It is one of their tasks, responsibility in agreeing upon what? The terms of an audit engagement. Okay. And where applicable, those charged with governance, with management and those charged with governance. So basically, you as an auditor have to talk to the management or the board of directors, those charged with governance, and tell them, hey, this is what the job we will do, and this is what you will do. Now, as we all know, that for any audit to take place or anything to take place on a good note, on a proper note with a good conclusion, you need to have some sort of a precondition. Like the conditions must be present before a job can be done. So this is known as a precondition. Now, for an audit, what does that mean? It includes using an acceptable financial reporting framework. The most common example, the most common example is your IFRS. Yep, the most common. Okay. The management's agreement to fulfill the responsibilities for financial statement preparation and of facilitating the audit process. Okay. So now you must have, hey, the financial statements will be in accordance with the framework, and management says whatever we are responsible for, we will ensure that it is done. The pretty general point applies to audits from 2009 effective date, which means the standard has been there. You have to follow it. Objective. Now, this is important. Okay, the auditor must ensure. This is you, the auditor, who has to ensure that the audit engagement is accepted or continued only when the preconditions are satisfied. Which means, what are the preconditions? These two. Okay, that management has a financial, there is an acceptable financial reporting framework, and management agrees to do what they are intending to do. A clear mutual understanding exists of the terms of engagement exists between the auditor, management, and governance. Like everyone knows, hey, this is what we will do, this is what you will do. Everyone is on the same page. Okay, without obviously not being on the same page, then obviously your situation can be difficult. Okay? And then you might not be able to do the audit. Preconditions, utilization of a okay, so this is the same thing, management agreement to recognize the responsibility for internal controls, information access. and preparation for the financial statement. So this is basically elaborated over here. Preconditions: the auditor verifies whether the financial reporting framework is acceptable based on factors like entity type and purpose of financial statements. Okay. Now, this is an important example. I'm going to explain to you. For example, in Canada, you have two financial reporting frameworks. You have IFRS, okay, and for smaller private companies, etc., you have SP. Okay. Now, you as an auditor, if you're, for example, auditing your financial statements in the Canadian market, you must ensure that which of these two is applicable, right? And what is the purpose of the financial statement? Management acknowledges responsibility for. Now, what does management do? See, you as an auditor say, hey, there must be a financial reporting framework. I will give an opinion. That's fine. But what does management says? Management acknowledges responsibility for preparing of the financial statement. Now, this is very important. As for the framework, ensuring fair presentation. Okay. What do you mean by preparing? That management will make the financials, you will audit it. Internal controls, what are these? These are the internal mechanisms to ensure that there are very lower amount of misstatements, to prevent and detect material misstatements, and provision of complete access to all records, documents, and personnel. So as an auditor can basically have a complete access to all records, documents, and personnel. Determining the acceptability of a general purpose framework. Okay, so general purpose framework, basically like IFRS. When jurisdictions like authorized standard setting organization or prescribed framework, management identifies an appropriate financial reporting framework. The management says, hey, we're going to follow this. Usually, this is not the case in current global markets of developed countries and even in a lot of countries now, and even in emerging markets, because most countries, for example, have adopted IFRS, right? Acceptability can be determined based on established accounting conventions, widely recognized jurisdiction, comparison with existing applicable frameworks to assess differences and their implications. Now, what are the key attributes of acceptable framework? They include relevance. Okay, this is important. Information meets the financial needs of users, such as presenting financial position, performance, and cash flows. Right? It has to be relevant. Completeness, no significant transactions or disclosures are omitted. Okay, this is important that every information is there. You as a person can basically study, read the information, and make some sort of sense out of it. Okay, reliability, you can basically rely on it. Information reflects the economic substance, not just legal form. So this is an accounting concept: substance over form, and ensures consistent evaluation. Okay, so an example can be a lease transaction in which the economic substance is maybe you are using the asset, but the legal form may be a little bit different. So, there are various situations where substance over form happens, right? So you have to tell what the actual business or the economic substance is and ensures consistent evaluation. Neutrality, information is unbiased, which means basically you cannot have some sort of manipulation or bias towards it. An objective, it tells exactly what it's supposed to tell. And understandability, clear, comprehensive, and not open to significant misinterpretation. Like for example, if the company is saying loss is a loss, then that's understandable, right? There's a loss, there is a loss. But if they're saying based on this, the loss is this or this and that, then it's unclear. So obviously you cannot present things like that. You always have to make sure that the information is understandable, and IFRS ensures that happens. Framework must not be a collection of ad hoc conventions tailored to individual preferences, right? You cannot say, hey, just because the accounting requirement is suitable for me, I'm going to follow this framework. No, the standardized framework so that everyone has a similar benchmark on which to measure their performance. Limitation on scope prior to acceptance. So what does limitation on scope means? For whatever reason, the auditor cannot do their job correctly, right? Maybe they're not given access to the information, right? Or whatever. So this is known as limitation on scope, right? if the proposed audit engagement restricts the auditor's ability. And what do you mean by restricts? The auditor cannot do their job. To form an opinion, the auditor must not accept the engagement unless mandated by law. Such limitations include withheld information or restricted access to key personnel. Okay, this is important. Withheld information. They didn't tell you anything, or they said, hey, you do not meet the X person or Y person, then that is a limitation of scope, right? Then you cannot accept the engagement unless and until there is some legal requirement. Because otherwise, if you don't have access or you don't have information, how will you check it? It doesn't make sense. So that's basically what's known as limitation of scope. Then you say, hey, sorry, I cannot do the job, cannot do the audit, you know, because I can't do my job properly. Agreeing on audit engagement terms, the terms must be documented in an engagement letter, equivalent written form, include audit objectives and scope, what the auditor was there for, auditor and management responsibilities, applicable financial reporting framework, for example, IFRS, relevance to expected audit reports, including potential variations in form or content. If the law or regulation prescribe terms, the agreement may reference the specific provisions while ensuring management acknowledges its responsibilities. Okay. Recurring audits. Recurring audits are, for example, you audited the company last year, now you're auditing them again. For repeated engagements, the auditor must reassess whether changes require revising the engagement terms, otherwise remind management of existing terms. Changes in terms of the engagement. When allowed, changes are justified by circumstances. Reduce audit scope due to new requirement. When not allowed, okay, so this is known as allowed. And is it not allowed? Changes driven by management reluctance to address identified risks. Okay, when you can change the terms of the engagement, as in the term, changes are justified if it is not allowed. When it is not allowed, that changes are driven by management reluctance to address identified risk to provide necessary information. Management is saying, hey, don't audit this area, don't audit that, forget the information. No, then you cannot change the terms of the engagement if the terms cannot be agreed upon. Auditor should withdraw. Basically say, hey, I cannot do the job. And consider reporting the obligations to stakeholders. So this is important. Then you report it to the stakeholders. Okay. Financial additional consideration that is engagement acceptance. Financial reporting standards supplemented by law. Now, most companies, what do you mean by supplemented by law, may have a Companies Act or some regulations which you have to follow, right? If, for example, your law does not match these standards, that is a legal regulatory requirement, conflict with established standards, then you have to discuss option to address discrepancies. Maybe give a supplementary disclosure that the law requires this, standards require this, amend descriptions of the reporting framework if possible, modify the audit opinion if the conflict remains unresolved. Framework prescribed by law, even if a legal framework is unacceptable, the auditor may accept the engagement if additional disclosure clarify misleading elements. Included an emphasis of meta paragraph in the report to draw attention to these disclosures. Okay. Like for example, the framework is unacceptable, but if the auditor says I'm going to give additional clarity and then show an emphasis of meta paragraph. This is a reporting area. We're going to see that when we are in the reporting standards, hopefully. Auditors remote format prescribed by law, which statutory format significantly differ from ISA requirement. Assess whether users might misunderstand audit assurance. If unavoidable, avoid claiming ISA compliance. Okay. Okay. For example, statutory audit reports are different. Then you say, hey, if I do the legal audit report, maybe the requirement is so different, then what do? Then you might say, hey, because the law is so different from the auditing standards, maybe we can follow the ISS. That depends on jurisdiction to jurisdiction. Public sector entities are usually government entities. They involve statutory responsibilities such as reporting to ministers or legislatures. Obviously, it's the government. The law prescribed terms. The auditors may issue a more detailed engagement letter for clarity. Regulation guidance explains nuances of preconditions, engagement letters, and specific scenarios. Okay. Framework acceptability evaluate based on entity type, purpose, and user needs, general purpose, special purpose frameworks. Basically, for example, if you have very specific reporting requirements, your framework might not be IFRS. But generally, usually, IFRS do the job for, like, for example, for listed company, etc. Engagement letters essential to outline scope, responsibilities, and expectations. You have an engagement letter in which obviously you are going to tell the terms of the engagement, then tailor it to include additional factors like involvement of other auditors, fee arrangements. Obviously, audit is also a business at the end of the day. So you have to have the fee arrangements and working paper provisions. Smaller entities highlight management responsibility when third parties assist with financial statements. Okay. Let me just change this view. Sorry about that. Okay. So all of these, as discussed earlier, all of these basically areas will be in an engagement letter. Okay? So this is the uh, appendix from the standard, which shows you an example of an audit engagement letter. Okay. So this says the following is an example. Da, 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 da. Letter is not authoritative, only to be a guide. It will need to be varied according to individual requirements, circumstances, drafted to refer to the audit of financial statements, and would require adaptation or expected flag regarding it. May be appropriate to seek legal advice that any proposed letters would. So they're saying, hey, this is just a guide. Okay. But let's just read through. To the appropriate representative management of those charging governance of ABC, for example, might be the board of directors of the CEO, the the objective and scope of the audit. ABC, you have requested, which means the management, okay? You have requested that we audit the financial statements of ABC company, which comprises statement of financial position, which is the balance sheet, the statement of comprehensive income, statement of changes in equity, statement of cash flows, and notes to the financial statement, including material accounting policy information. We are pleased to confirm our acceptance, our understanding of this audit engagement by means of this letter. So basically, it's a written acceptance. They're saying, hey, you wanted us to audit, we are there for you. So what do we do? The objectives of our audit. Now we're going to explain reasonable assurance again, which we studied in the last video. So reasonable assurance is about whether to obtain reasonable assurance about whether the financial statements as a whole are free from material misstatement, okay, whether due to fraud and error, and to issue an auditor's report that includes our opinion. So we're going to be expressing an opinion, right? Reasonable assurance is a high level of assurance. Okay, so we already discussed this, but you cannot be 100% sure ever. It is not a guarantee that an audit conducted in accordance with the international standards on auditing will always detect a material misstatement when it exists. Obviously, there are various inherent limitations. Misstatements can arise from fraud or error. Okay, fraud, someone intentionally deceived you. Error, you made a mistake, and are considered material. When are they considered material? If individually or in the aggregate, they could reasonably be expected to influence the economic decisions of users taken on the basis of these financial statements. Okay, because if the amount is so material, then maybe your decision would change. That is being material. Responsibilities of the auditor. Again, we tell what we do. We will conduct our audit in accordance with the international standards on auditing. Those standards require that we comply with ethical requirements. We had a little discussion on ethics earlier, independence, etc. As part of an audit in accordance with ISS, we exercise professional judgment and maintain professional skepticism throughout the course of the audit. Throughout the audit, we also identify and assess the risks of material misstatement of financial statement, whether due to fraud or error, design and perform audit procedures responsive to those risks, and obtain audit evidence that is sufficient and appropriate. So we discussed that, hey, there are risks. We will do some procedures to counter those risks and then obtain some sort of an evidence. The risk of not detecting a material misstatement resulting from fraud is higher than that one resulting from error, as fraud may involve collusion, forgery, intentional omissions, misrepresentations, or overhead internal control. So I say when we go to the fraud, we will see that because fraud is done so that people don't catch you, it is more difficult to catch. So it's pretty sense, right? Because they make an effort. Someone who's a fraud doing fraud will make an effort that their areas and their unethical deeds are kept hidden, right? So that's what it's trying to tell you. After understanding of the internal control relevant to the audit in order to design audit procedures that are appropriate in the circumstances, but not for the purpose of expressing an opinion on the effectiveness of the entity's internal control. We will communicate to you in writing concerning any significant deficiencies in internal control relevant to the audit of the financial statement that we have identified during the audit. Okay, we're going to basically say, hey, we'll understand what your accounting systems, internal controls, etc. are like, and then we will communicate, if we see anything which is weak, so that you can improve upon them in the future, right? Let me just quickly zoom in. Evaluate the appropriateness of accounting policies used, reasonableness of accounting estimates, and related disclosures made by the management. So, whatever financials they give you, study if they actually make sense or they don't make sense. Conclude on the appropriateness of management use of the going concern basis of accounting. Now, what do I mean by the going concern basis of accounting? Going concern is an accounting principle which says that the business will continue for the foreseeable future, and this is usually 1 year, and basically for the next available period, the business can meet their liabilities based on the audit evidence obtained, whether a material uncertainty exists due to events or conditions that may cause significant doubt on the company's ability to continue as a going concern. If we conclude that a material uncertainty exists, right? For example, we say, hey, this is known as, the company will not be continuing for the foreseeable future. We are required to draw attention in auditor's report or to the related disclosure in the financial statement, or if such disclosure is adequate to modify our opinion. This going concern is a very important area. If you say the business might not be there from in 1 year, the investors will panic, right? So you have to tell the investors right now that, hey, make some arrangements. Make sure that that this business might not survive as per our opinion. Our conclusions based on the audit evidence obtained up to the date of our auditor's report. Future events or conditions may cause the company to cease to continue as a going concern. Evaluate the overall presentation structure and content of the financial statements, including the disclosures, and whether the financial statements represent the underlying transactions and events in a manner that achieves the fair presentation. Because of the inherent limitations of an audit, together with the inherent limitations of internal control, right? Basically, it says for this paragraph, it says the financial statements actually shows, you know, the business, and there are inherent limitations. With the inherent limitations in internal control, there is unavoidable risk that some material misstatements may not be detected, even though the audit is properly planned and performed in record sizes. Again, it says that, hey, we cannot give you 100% guarantee that everything will be fine, but we will, but there is a reasonable level of assurance. But again, some errors or some misstatements may still pass through. The responsibilities of management identification of the applicable financial reporting framework. For the purpose of this example, assume that the auditor has not determined that the law or regulation describes the responsible appropriate terms and descriptions are there for you. So this is basically right? So basically, they are saying, hey, this is what they are saying regarding the financial reporting framework. Right? And because the law regulation says, hey, you don't have to do this. That's what we're assuming. There is nothing there, so we are telling it here. Our audit will be conducted on the basis that management and where applicable as governance acknowledge and understand that they have responsibility for the preparation and fair presentation of financial statements in accordance with the international financial reporting framework. Right? So management will be the one preparing the financial statement. We already discussed this earlier. We are telling it in writing now for such internal control as management determines is necessary to enable the preparation of financial statement that are free from material misstatement, whether due to any fraud or error. So basically, internal control is also management's job, not your job as an auditor, to provide us with access to all the information of which management is aware that is relevant to the preparation of financial statement. The record documentation matters. So management has to give all of the information, additional information that will be requested from management for the purpose of the audit. Unrestricted access to person within the entity from whom we determine necessary to obtain audit evidence. So basically, you are saying, hey, give us all the data, any additional information, and access to any personnel. For example, you might need to ask someone something, understand something from the management or from someone in the organization, right? So we are allowed to have unrestricted access. We're not stopped in any way. As part of our audit process, we'll request from management and where appropriate, those self governance written confirmation regarding representations made to us in connection with the audit. We look forward to full cooperation from your staff during our audit. Other relevant information, insert other information such as fee arrangement, billing, and specific terms as appropriate. Okay. Reporting insert appropriate reference to the expected form and content of the auditor's report, including other information according to ISO 720. We will see hopefully in the reporting areas. The form and content report maybe need to be amended in the light of our audit findings. And then you say, please sign. For example, audit findings are different. We might need to change a little bit here and there. Please sign it on the attached copy of this letter to indicate your acknowledgement and agree of an agreement with the arrangements for an audit of the financial statements, including our respective responsibilities, acknowledged and agreed on behalf of ABC Company by its name and title date. So you will get a signed signature there. Now this letter will effectively basically agree the terms of the engagement. So you say, hey, we're clear on what we have to do, what the management has to do, and then you go to the next step of it. Thank you so much for listening to this session. We're hopefully going to be continuing these audit sessions and see you in the next section, hopefully. Bye bye.